So, as I was saying, a bankruptcy judge will eventually get upset when a bank appears to be dragging its feet, and the borrower has submitted multiple sets of documents, and we don't seem to be getting anywhere. So, a judge will, in many cases, subpoena a bank president or someone with some type of authority so that they can fly in and explain to the judge why it's taking such a long time to review your particular application. When that happens, in most cases, the bank president doesn't show up. Instead, your application just gets processed and a determination is made, and in many cases, it's a loan modification offer. So that, in a nutshell, is the advantage of pursuing a loan modification inside of bankruptcy. You have a single point of contact that is always responsive, and it's happening between two attorneys. And so the history of the document exchange is tracked, and everybody is on the same page with regard to what the issues are in a particular application, and they're more effectively resolved. And if they're not resolved, then the bankruptcy judge can step in and make things happen. So let's talk for just a minute about how these tools, the removal of a second mortgage and a successful loss mitigation proceeding, can impact a bankruptcy plan. So, as I said, you have a 5-year bankruptcy plan. You're paying back 100% of your mortgage arrears at 100 cents on the dollar. Any kind of income tax debt or domestic support obligations, 100 cents on the dollar, and then you have this percentage of the unsecured debt that's being paid. So, in a straight bankruptcy, let's suppose you had a home worth $150,000, and then you had a first mortgage, and the balance on that first mortgage was about $180,000, and it includes $30,000 in mortgage arrears. And then you had also a $30,000 HELOC that was completely unsecured to the house. And also you had something like $50,000 in credit card debt, and then we'll skip the tax debt and the domestic support obligations just to simplify things. So at the outset, the first thing that you would do is you would get rid of that second mortgage with that pawn motion. So let's suppose you hadn't filed a Chapter 7 before, so you're going to reclassify that $30,000 HELOC as unsecured debt. So that becomes basically $80,000 in unsecured debt as part of your plan. Then you want to pursue a loan modification. So the first thing that happens in any loan modification, now let me just back up. Let's say you didn't do a loan modification. Your plan would include $30,000 in arrears, along with $80,000 in unsecured debt, which at 10% is really $8,000. So you would basically be paying $38,000 back over a period of 5 years, and divided by 60 monthly payments, that roughly comes out to, I think, $700 or $800 a month, which is a lot. However, if you pursued a loan modification and you got one, the first step of any loan modification is to take those arrears and put them back into the principal, and all of a sudden you're current. So without those mortgage arrears, that $30,000 disappears from your plan, and instead of paying it back over 5 years, you pay it back over 30 or 40 years or whatever the life of your mortgage is. Then all you're left with is the $80,000 in unsecured debt, which is, as I said, reduced to $8,000. And that comes out to about $150 a month for 5 years, which, if you consider the fact that you're getting rid of all of your unsecured credit card debt, and you've gotten rid of your entire second mortgage, you've brought your first mortgage current, and likely obtained a reduction of your interest rate, an extension of the life of the loan to make that monthly mortgage payment more affordable, and you're doing that at $150 a month for 5 years, that is a considerable benefit. It would save you an enormous amount of money. So a Chapter 13 can be a very, very powerful tool in helping you reorganize your debt. Now, one other aspect of a Chapter 13 that has to be considered is that, and in any bankruptcy, is the automatic stay and it's generally the impact that bankruptcy has. So an automatic stay is thought of as a benefit to the borrower, the debtor. In the context of a Chapter 7, you know, this is what's going to make the telephone call stop. This is going to prevent people from filing lawsuits against you in state court and getting judgments against you. As soon as you complete and file that petition with the help of an attorney, then any action by a creditor, the purpose of which is to collect a debt, has to stop. And they have to file a claim in the bankruptcy, and they have to get paid out according to the rules of the bankruptcy code. Okay, so in the context of a 13, this could include, well, in both a 7 and a 13, it's going to stop a foreclosure action. In a Chapter 7, it's going to stop it for about 3 to 4 months until the case is closed, and then it will resume because Chapter 7s don't affect mortgages. And in some cases, because of that, they can file a motion for relief from the automatic stay and pursue their foreclosure action more quickly. In a Chapter 13, it stops a foreclosure action period, right? And then we're going to deal with that mortgage in the bankruptcy. One of the aspects of a foreclosure action, however, is that you are not allowed to make a mortgage payment. You can't foreclose on someone's house and accept their mortgage payment at the same time. Okay, but what that means is the automatic stay enables you to begin making your mortgage payment again. That is a curse and a blessing, right? Because now you have to make your mortgage payment again, but then also, you have to make your trustee payment, the plan payment, and so it's not. It doesn't make things easier, you know. It's not easy to do a Chapter 13, and a Chapter 13 is most appropriate for people who have had financial hardship at one point. They've resolved that financial hardship and they're making money again. They have stable income, but that financial hardship caused mortgage arrears and credit card debt and things that you just can't get out from under. Even though you have a steady income, you don't happen to have $50,000 sitting there to catch up on your mortgage and things like that. So a Chapter 13 will give you that breathing room and allow you to reorganize your debt so that you can get back up on your feet with your new job, or whatever circumstances have enabled you to recover. I forgot my point.